To understand today's financial traps, we must go back, way back, long before credit cards, digital banking, or central banks. Back to the earliest families who discovered a timeless truth. If you can control the flow of money, you don't need to control the people. They will control themselves. Centuries ago, wealth wasn't measured in dollars. It was measured in grain, gold, land, or livestock. But the elite of those times faced a problem. As civilizations expanded, rulers discovered that controlling physical wealth was messy. Armies were expensive. Territory had limits. Gold reserves could be stolen. But controlling abstract wealth, credit, lending, us was clean, efficient, scalable. By the 1600s and 1700s, a new class of elites emerged. Not kings, not emperors, but bankers. People who realized money didn't have to exist to be powerful, only had to be believed. Enter early central banks, not created by governments, but by private interests, who loaned governments the money they supposedly printed. Debt became a national product. Interest became a tax hidden in plain sight. And the ordinary person, their role became simple: work, borrow, repay, repeat. For the first time in history, people didn't just serve rulers through labor, they served rulers through interest. And interest never sleeps. The world's most important financial shift happened quietly in 1971. No riots, no protests, no warnings. Just a single announcement. The US dollar would no longer be backed by gold. In that moment, money transformed from a physical asset to a concept backed only by trusting, enforced by policy. This was not an economic adjustment. It was the birth of a new era. An era where money could be created endlessly, as long as someone was willing to owe it. And when money is infinite, but debt is real, guess who pays the price? Not the people who print it, but the people who borrow it, live by it, depend on it. The breaking point wasn't just economic, it was psychological. People believed money was real. The elite understood it was a lever. After 1971, 4 mechanisms cemented themselves into society. Machines designed not to help the public, but to maintain control. Mechanism number 1: perpetual inflation. When money can be printed without limit, its value drops silently. The same paycheck buys less every decade. Savings melt. Wealth trickles upward. Inflation is a hidden tax, one the rich avoid by owning assets. Mechanism number 2: engineered debt dependency. Student loans, mortgage loans, car loans, medical. Every decade, governments promise solutions. We will reduce inflation. We will cut interest rates. We will forgive debts. We will regulate banks. And yet, nothing improves. Why? Because the systems being fixed aren't broken. They're functioning exactly as designed. A machine running perfectly will never be replaced. It will be maintained. Look at the last 20 years. 2008, a crisis created by elite speculation wipes out global wealth. Banks get bailed out. People lose homes. 2020, markets collapse again. Billionaires gain hundreds of billions. Everyone else takes on record debt. 2023 to 2024, mass layoffs, soaring interest rates. The story begins in the late 1600s, when European empires finally realized something shocking. You don't need military power to control people. You need financial dependency. It started with central banks, the first mechanism. When nations couldn't fund wars, expansion, and political agendas through taxes alone, they turned to a new idea: create money out of promises. Control its flow. Control the population. This was the birth of the national debt, a concept unheard of before. Kings, they grew more sophisticated, harder to detect, easier to justify. Mechanism number 1. Inflation as a hidden tax. Inflation was introduced as a natural part of the economy. But here's the truth. Inflation is not an accident. It is a tool. When governments overspend, instead of taking responsibility, they simply let inflation quietly drain the purchasing power of ordinary people. Your money weakens, their debts shrink. It's the perfect. The world changed completely in 1971. This was the moment when money stopped being tied to gold. It was the perfect turning point. Mechanism number 4. Money that isn't real. Once money was detached from physical value, elites had total control over its supply. They could create trillions with a signature. Meanwhile, workers still had to trade hours, labor, and life for money that decreases in value every year. The system was now fully engineered. You weren't earning money. You were earning time. The result of these mechanisms has become obvious. 1. The middle class collapse. Homes once cost 2 to 3 years of income. Now they require 15 to 30 years of debt. 2. The savings trap. Saving money doesn't make you wealthier. It makes you poorer as inflation eats your balance slowly, silently. 4. The wealth funnel. A tiny group now holds more wealth than billions of people combined. A direct consequence of engineered mechanisms that funnel money upward. But what's worse? Every crisis, every crash, every recession, every collapse strengthens the elites even more. Because when the system fails, they get bailed out. Every financial crisis leads to the same political promise. We must reform the system. And yet, the mechanisms never change. Why? Because the reforms are designed to look helpful, while protecting the elite architecture. Regulation targets small players, never big institutions. Stimulus pumps money into the financial system, inflating assets the rich already own. Financial education sounds empowering. Look around today, and the same architecture is unfolding in new forms. Digital surveillance, banking. Central banks are pushing digital currencies that allow total monitoring and programmable control. Mass credit dependency today. The average person lives on subscription payments. Inflation at 40-year highs. A full transfer of wealth from workers to asset holders. Again, the origins of elite financial control go back far earlier than modern banking. We can trace them to three major historical turning points. Point number 1. The creation of royal debt in medieval Europe. Kings realized something dangerous. Wars cost money, and taxes weren't enough. So they turned to private lenders. The moment they did, the power dynamic. Financial control is not a modern strategy. It's a pattern, a method repeated across civilizations, ancient empires. The first debt traps thousands of years ago. Rulers realized a simple truth. If people owe you money, you control their future. The ancient Mesopotamians created debt tablets, stone records of what farmers owed the ruling class. If you couldn't repay, you lost your land. If you lost your land, you lost your freedom. Debt was the earliest form of economic slavery. Fast forward to the Roman Empire, and the pattern grows sharper. High taxes funded wars. Wars caused inflation. Inflation destroyed savings. Ruined citizens became dependent on the state for survival. Sound familiar? Because the template didn't disappear. It evolved. By the 1600s, a new form of power emerged. Bankers who could lend to kings. The moment rulers needed money, financiers gained leverage. This led to central banks, government bonds, fractional reserve lending, interest-bearing currency. This wasn't progress. It was consolidation. Consolidation of control into hands the public never elected.